that's one of the coolest things that we're doing here is that we're building this community of either whether it's vendors, partners, like Artez, like they're somewhat in our space, but not really. They do more commercial versus residential. But Scott has been such a great ambassador for us, just an educator, and we're figuring out ways. How do we work together on future projects? Is it we share information? Do we co-fund into deals? And having that kind of like to do bonfire, right, where
Yeah.
we build this community is something I didn't have at Quanta, and to be quite frank, we didn't have at Genesis. So to incorporate that on this next iteration of this this company that we're doing, it gives me all the confidence in the world that we're gonna do really well.
Dear friends, it's Kurt Derdix, and welcome back. If this is your first time listening, I am so glad you found us. This week, I am beyond excited to share my conversation with my friend and business partner, Justin Mitchell, founder and CEO of Realworld Asset Group. A string of auspicious events connected Justin and I and opened the door for us to collaborate. And after working on RWA Group for a few quarters, we are delighted to inform the world that we are now open for business. RWA Group is a private credit real estate investment company led by a seasoned management team with a proven track record of providing creative funding solutions to professional real estate developers nationwide, delivering superior risk-adjusted returns to investors. And our first product is a high-yield REIT built for accredited investors. And there is so much more to the story. And what's exciting is there is so much that is still unwritten. We invite you to join along and be a part of the awesome community that we're building. That's really fundamental to what we're trying to achieve. And I think this is an incredible example of the Imagine a Day exercise that we highlighted on episode 50, which I invite you to explore as well. And without further ado, it is my profound privilege and pleasure to introduce you to my friend and business partner, Justin Mitchell. Justin Mitchell, it is so good to see you, my friend. I've been really looking forward to this for so many reasons. And it's like the perfect timing because we launched the fund this week. Amazing.
Exciting times.
Oh man, I this is going to be a fun one for guests, audience members to follow along. For me, it's extra special. I think this is a great example of the Imagine a Day exercise, and I think a year ago today, October 6th, Holden and I moved into our house where we're living here in LA. And then on the Monday, 3 days later, I'm in this office that I'm in right now. I found out that the City Source deal was going to happen. I was going to get paid. And it was
Wow.
through that time that I was imagining what I wanted to do next. I was like, if I could do one thing, like one part real estate, the first bit of my career, one part tech, and then the next part finance. And then it was just this most amazing, like kind of auspicious time that you were, reimagining your day. And so I'm really, really excited that we get to kind of unpack this. And, hopefully it's for folks that are following along just with the show. I think this is a great example of some of the principles we're talking about. And for folks that are interested in what we're doing at Real World, I think this will be great context about why I'm so excited to partner with you, Justin. And I just thank you so much for the opportunity to ride along, because it's already been so fun and we're just getting started.
Yeah, and the other way around too. I'm super excited to be doing this with you, Kurt. And it's been a little bit of a journey, but an amazing one at that. And it feels so good to be officially launched and you riding shotgun. And I think we're going to do some really special things.
Yeah. And we've got Elias as our third partner,
Yeah.
CFO. He usually sits right behind you. He's at home today. And so give the audience some context. Where are you right now?
So I'm at our office in Westlake Village. Um, it's our second office. So if you want to count your living room as our first,
Yeah, yeah, that was
this is
HQ1.
our
We got HQ2 now.
yeah, yeah, HQ two.
Now I'm
Um,
HQ2.
yeah, yeah, yeah. But yeah, here it's a beautiful day. And yeah, it's a beautiful office. For those who are in the area, we'd love to have you stop by and come hang out with us.
Yeah, and it was so wild. Another auspicious thing when we walked into the office for the first time. It's like a kind of a shared space, and my buddy Tim Rhodes was in there in the conference room, and I played in a band with him. And he's three doors down, one of my best friends. It's like, I mean, it's just one of these things where sometimes when things are ready to line up, the universe tells you. I think that's a great example segue into how we met. We met during COVID on an auspicious day. I got invited by my friend Brooke Fain. Hats off to Brooke for the invite and for being an awesome friend. And he was my broker when I was a mortgage broker 15 years ago, pre GFC, pre Great Financial Crisis. And I reconnected with him through COVID after we moved back to Ventura County, and he invited me to play some golf, and that's where I first met you. And you were wearing a Quanta hat, and I was like, "Oh my gosh!" My friend Ryan Burke was going to introduce me to Quanta, and I was in a real estate mastermind with Ryan, and Ryan was my first boss out of college, actually. Um, and Ryan was raving about how awesome you guys were, and he wanted me to get a credit line set up to invest. And so it was this really wild thing where I met you sort of in this context, and then we ended up hanging out after golf in the club, geeking out about tech and digital assets. And that was when crypto was just on fire, and that was a really memorable day. I will never ever forget that day for so many reasons, especially in the context of what we're doing now.
Yeah, I mean, likewise. And we didn't get to share a card together, but the last hole we started chatting, and that was a perfect segue into the clubhouse to have lunch. And then I feel like an hour became 3 hours really quickly, and it felt like we had known each other for so long. And I think if you remember, you invited me to meet afterwards with a real estate client that had been in town from I think Miami. I forget the gentleman's name, Andy, who does some build to rent stuff, and
Yeah, yeah.
we
Andy
just
Talbert,
continued
he's
on.
great.
Yeah,
Yeah.
yeah,
Oh, so
and
we did that the same day.
yeah,
Oh my gosh, that's classic Curdy D.
yeah. And so we went to the clubhouse and we went to
Yeah, yeah.
Stonehouse,
Yeah, the
and
Stonehouse. Yeah, that was great. And then you and I ended up making Stonehouse our ritual through
yeah,
COVID, and we would meet up like once a month.
right. And it
Yeah,
just such great conversations just about life and real estate, tech, um, and we just continued that tradition every month and grabbing a beer and talking life. And here we are,
yeah,
what, three years now later, and
yeah, yeah, something.
starting a business together, which is incredible.
Yeah. Yeah, it's incredible. So we've been, I mean, there's a lot to unpack. I think let's give the audience some context about what we're building. Real World, where essentially it's a mortgage REIT, and we invest with top operators and developers in tier one cities throughout the US. And Justin's track record is remarkable. And we can't talk much about the fund specifically in this conversation because of regulation stuff. But if anybody's interested in the fund, you can go to rwagroup.io. And if you don't know us directly, you can just fill out an inquiry form, and we'd be happy to get you all the materials. And if you do know us, you'll probably be hearing from us soon to get involved. So, but yeah, I think the milestones so far are we're now live. We're now up and running. The fund's up, and we got the office going, which we're really excited. Did a great job on finding the space. I think we've been there like 3 or 4 weeks now.
Yeah, it feels like a longer time, but yeah, we've been officially here for about that time, about probably a month.
Yeah, and then you and I started working on. You started working on it late last year, and then I left Hunt Club on good terms to catch my breath through the holidays, and you gave me some a minute to catch my breath, and then we started working on it in Q1. And then,
Yeah,
yeah, I mean, and then this summer, we got everything finalized with all the vendors. We got such a great team with our tax and audit partner at Cohen Resnick, our fund admin, partners admin out of Carlsbad, who has a specialty in private credit. We have incredible attorneys, thanks to PAG Law. Back east, your crew
Potente.
with Patente. I mean, we can go on and on, but we this journey. I mean, I think you were along for most of it, but I was, me being kind of a little OCD. I think I interviewed 9 attorneys.
Yeah. I was probably a little turning out by I think the third round, but yeah,
Yeah, and
yeah,
it all worked out. So, geez Louise, I part of it was so. I mean, I was learning so much on the fly, and I would just sort
yeah,
of like, hey, because I mean, what we're doing is, we have a big vision to create a machine that's really good at sourcing capital, and there's a lot of opportunity internationally as well. So we had to sort of begin with the end in mind, and we really wanted to back into it and make sure that what we were building could kind of scale. And I think we have a really good plan. But first things first. So yeah, and then we're gonna start doing a bunch of events and kind of getting out there, and I'm not a full on road show because there's so much capital here in California that we don't really need
yeah,
to go far from
yeah,
home. But yeah, I guess I do want to get into your background a bit, but maybe for some context, if we could talk a little bit about just the core investment business. We have if we could talk a little bit about the borrowers that we invest with, kind of the typical loans, and also a little bit about the collateral. And then we could
yeah.
press rewind a little bit about your background.
Yeah. Do you want me to go through my background first?
Why don't we talk really quick about the yeah, yeah, before Eliza, let's cut this out. Before we get into the core business, we'll talk about who we lend to. Excuse me. Oh, let's edit that out. We'll talk about who we invest with. We'll talk about the loans that we do and the collateral. But let's press rewind, Justin, and talk a bit about your background, which is really impressive. You
Yeah,
basically you cut your teeth, great financial crisis, and I think that's really a lot of
yeah,
why you're such an amazing risk manager. So let's get the audience cut up.
yeah, yeah. So I started my career at Countrywide on the secondary market. I think 2 or 3 weeks into the job. I want to say sooner. I feel like it was like the first day on the job, the market crashed, and
This
it
is an
was
'08,
an
or
eye
was it
opener.
'07 or '08?
'07.
Yeah.
And so a lot of things start to happen before I think it starts to hit the broader market, internally. And it was incredible. I mean, it went from this huge, beautiful trading, floor to a ghost town within a matter of weeks. And the floor at the time was trading these mortgage-backed securities to, Freddie, Fannie, the Goldman Sachs is the big private investment banks, the monolines. Monolines are the insurers that insure some of these securitizations, and the private mortgage insurance companies as well. So everyone had their hand in buying these securitizations, and so what eventually happened was we went from doing that to now protecting the company from buying back all these securitizations, and that was an interesting run from for the next 5 years. So in the company, the risk side of that group was 20, 25 people at the time, and we grew to many, many thousands.
So
And
this
it
is
was
when
just
the
this whole
Bank of
exchange.
America, Bank of America absorbed Countrywide.
Yeah.
Yeah.
At that point, early on, Bank of America was a large shareholder in Countrywide, and they really wanted to get access to the residential mortgage market, and they did that via investment through Countrywide. And so I think they absorbed their investment, bought us out, and we essentially merged into Bank of America. But it was a very turbulent ride for the next, I would say, 3 to 4 years. But really, the first year or two, we didn't know where the market was going. The stock price, I think, hit Bank of America at one point almost hit $1, which was crazy. Um, but in the back of my mind, I always had this intuition that the government wouldn't let a bank with our country's name on it go out of business, such a staple of a company. And that's essentially what happened. And then we started the economy started to rebound, and we found some footing. So I did that for the last, I call it about 5 years,
Real
and
quick,
then
what team were you on there?
the secondary market.
Yeah. And then when
risk
you
risk risk management division. Yeah.
yeah.
So we were going through all these files that we had sold, and looking and reviewing the files, because all these investors wanted us to buy them back, and so we had to assess the file again and look at, do they have a claim against us in terms of, should we buy this back? And a lot of what came of that was a ton of fraud, um, misrepresentation, a lot of things that these really, really loose guidelines were just rampant, and which is why it led to everyone getting all this easy credit for so long. And we're buying back millions, 20 to 50 million a month in these mortgages, and it ran like that for years and years and years. And I think we
And
just settled. I mean, as of like 6 months ago, I think they just settled their last um, lawsuit with Aflac, or it's Aflac and back, for, I think it was like some multi-billion-dollar settlement, and I think that's the last of it. Think about, that's 12 years later, after, not even, almost 15 years later
yeah.
after that
Yeah.
run.
So when you
So
started on that team, 30 head count, and it scaled to a few thousand, right?
yeah, yeah,
Yeah. And then
I think it was over 5,000 people. Yeah,
that's remarkable. And you saw all the bad habits and kind of got aware of the bad actors, and learn how to scan for risk quickly. And feels like that's really embedded in your muscle memory now. And you did that
yeah.
at
I mean, it
such a
really
high
is.
volume.
Yeah, learned a lot of things of how to look at how people kind of can game the system, how people can state one thing, but you need to check for another. Always, I learned this from one of my mentors. Always, you trust, but you verify, right? I think as humans, we want to trust, but it's always second nature. You should be verifying everything.
Yeah, first principle. I love
Yeah.
it. And then then you had a big success with Genesis. What was the trigger to move to Genesis, and tell us about that amazing journey?
It's oddly enough, one of my good friends. I was trying to get him to come to Bank of America, but it wasn't a good hiring time, and he was just coming out of school. And so he had taken a flyer on a company called Genesis, and they were starting to grow. And he had said, "Hey, why don't you come in, and I don't know, maybe there's room for you over here. We can, we're doing some cool things." And so I had an interview over there, and I essentially loved what they were doing, and I left Bank of America to this startup, and this startup was essentially helping all these banks. Sell their real estate owned assets they had foreclosed on through the crisis, and move them off and recoup liquidity. And we did that for, that was a good business of the company. And it's similar to like an auction.com. And we said, in the midst of that, well, why don't we lend money to these investors who are buying off the platform? And it became a very, very widely successful business as well. So we had the auction platform, and then we started lending money to the investors. And Oaktree Capital Management came in and backed us with a huge chunk of equity, and a good fund behind it. I think it was several hundred million. And what we really did, we institutionalized hard money, and we grew it into a very big business along with the auction side. And for 4 years, we sold it to Goldman Sachs, and then we sold the auction side to Fidelity Investments. And so from that, that was a great run. And then from that, I
Real
left for
quick,
about,
I wanted to comment. Oak Tree Capital as a backer is incredible. Howard Marks,
yeah,
legendary investor, private credit guru, and yeah, local LA guy. And what a great story. You were employee 5 there, right?
25. Yeah.
Yeah.
So great.
Um,
I learned so much at a young age. The do's and don'ts as entrepreneurs.
mm, yeah. Any
And
mentors or bosses there that really you stayed in touch with or really helped you out?
yeah, I'm still pretty close with Andrew Smith, who was, in my opinion, the reason why we got to where we were at. Mainly because he's a New York institutional guy, and he was the one that brought in those relationships to sit in front of Oaktree, to sit in front of the Blackstones, just get us some looks early. And it just so happened that when he had reached out to, I think, Oaktree, they were just about to, they were really interested in this business, and
Mhm.
figuring it out. And it was a perfect, talk about market timing. It was perfect timing. And
Yeah.
yeah, and the rest is history.
Yeah. What do you think Oak Tree liked about it?
I think at the time it was a really fascinating asset class, and where you can get a high, sort of mid to low digit, double digit yield for taking a very modest risk. And but they've tried. I think at the time they had tried to do it with another company. It just wasn't working out. And because
Yeah,
we were kind of a newer, earlier company, they were able to put their mold on it, and take a bigger controlling interest in the company. So it just
mhm,
it just worked out that way.
yeah,
And I think
awesome.
Howard Marks is one of the, in terms of debt. He knows what he's doing, and I think he liked the asset class.
Yeah, yeah. Well, our sort of category has a very nice risk-adjusted return, very positive, sharp, and it is it's a beautiful thing to be able to lend money on a rock solid, pristine collateral that's secured debt. So
Yeah.
yeah. How long were you at Genesis, and then what was the next thing you did after that?
So at Genesis, I want to say it was about just maybe short of 4 years, and then I left for a Blackstone company. It was, at the time, it was called Dwell Finance, which was just acquired by Blackstone, and then we were absorbed by their other finance company called B2R Finance. Um, but
So it's
essentially, what
Dwell, Well, Dwell
yes,
Finance.
Dwell
Got it.
Finance, yeah, founded by Gregor Watson and Rob Blunker, who were the founders of One Sharp, who were big partners later down the road. But um, what we were essentially trying to do is, again, trying to find the best operators in tier one markets and help them with these lines of credit and grow their business. And essentially, we were trying to kind of not only do that, but also roll up some smaller hard money shops that were, institutional, had some institutional promise, and grow the business. Similar to a venture I think Blackstone was doing at the time was where they had done very well. It's Invitation Homes, which was accumulating all these single family homes, stabilizing them and putting renters in them, and that became a wildly successful bet for Blackstone. They crushed it. I think they're the largest landlord in not only the country but the world. They've got over, I think, I want to say 150,000 units, single family units, which is incredible. Um, so to try to do the same thing but in the lending world, and it was a good run. We just we I think we were too successful. We blew through money too fast, and they just didn't want to recapitalize the business. So
Mhm.
that's when I left that and started Quanta with my partner at the time, and trying to do the same thing.
Yeah, one thing that I love about the Blackstone story, and you've heard me say this, but for the audience and people that might be in the finance crowd, is that the story I heard is that they just started out with the first fund, in the '80s, and then they just sort of were mindful about the next opportunity and the next and the next, and they just were really smart about it, and here they are,
Yeah,
one of the largest funds and asset managers in the market. It's incredible.
yeah, yeah. I mean, incredible. Yeah, it really is. And at the time, and I still believe in this. I mean, they're very opportunistic. I think they're always ahead of the curve. They have incredible real estate track record, right? And so
Mhm.
to have that as on your resume is it's definitely a game changer.
Anybody out of that community that you still keep in touch with or really were kind of learned a lot from, and also anything about kind of working inside of a Blackstone kind of framework, just from an organizational kind of operational efficiency that impacted you?
I would say it was such a quick journey. It was so fast, so quickly moving. I still keep in touch with Gregor Watson, who was the owner of Dwell, sold it to Blackstone.
Mhm.
I think he was chairman still of the company. Smart guy, ahead of his time in terms of being an entrepreneur, and I think taking all these venture bets. But I learned a lot from him. Just he's really smart. But essentially, it was it was a quick journey. I was there for a year.
Yep.
Again, because not all funds are created equal. When people
Yeah.
hear Blackstone, you get enamored with that, saying, "Oh wow,
Yep.
this." You hear they're raising 30 billion there. Yeah, they've raised 10 billion there, and they've got this unlimited war chest. But this fund essentially was started with a goal in mind, which was, I think it was several $100 million, and they weren't they weren't intending to recapitalize it. So what happened was we blew through that so quickly,
Yep.
and we weren't able to recapitalize based on the need, because at the time it was like, I think it was probably like 2014, 15, and the market was ripping, and we had a lot of really great institutional guys that were buying anywhere from 20 to 100 properties a year, and that's a big thirst to try to fulfill. And it made it challenging when we ran out of money. So that's eventually how it kind of dissolved from that, and got absorbed. That's when it got absorbed into I think it's Finance of America now. So they sold the company to Finance of America, and I went about my way and started Quanta.
Well, I think that's a great segue. And then you ended up doing a bunch of work with Gregor at Quanta. So tell us about Quanta, because that was sort of what got us connected in a
Yeah, so
way to
Quanta
work
was
together.
really trying to emulate what we did at Dwell, and carry that torch, because we really believed that it was a great product. And so we essentially just went out and we did the same thing, offer these lines of credit to prolific borrowers who were best in class in their markets. And we would establish their business, underwrite their their financials, underwrite their track record more than anything, and they had this ability to buy and flip. And we'd say, okay, we've built this product, right? And then we'd give them a line of credit, and then as they fill that line of credit, we put these first trust deeds against the property, and they'd pay us back, and it would be a nice call it yield, and we just recycle the money. Gregor, One Sharp Capital, um, really was a machine for us. They would purchase our paper, but we would service manage that paper and earn a strip. And then they gave us a warehouse line that allowed us to build a balance sheet so we could originate, and then we would sell that paper off to the hedge funds. And it was a great relationship. We did many billions. I think we did about 4 years, 5 years. We did about 2.5, 2.6 billion in originations. Right, no loss of capital. Many hundreds of billions repaid, and we built a great partnership. And I think we did such a good job. They really leaned on us when they had issues outside of Quanta, which, I mean, spoke volume, right? When you're working with one of your partners to help you out with other partners. And my partner at the time, John Melidio, he was, he came from Invitation Homes. We were borrowers ourselves. We flipped. We've owned property. We've developed property. So we know what it's like to be a borrower and what the sensitivities are. And speed of execution, and honestly, most of all, creativity is everything. And there's a balance to that, right? Being creative, but also managing risk. Whether that's with the asset that I'm lending on, or maybe I take additional collateral outside of that asset so that I feel even better, right? And that framework has worked so well for us. And again, no loss of principal. Have we had our challenges with some properties? Of course. I don't think you do. You don't lend $2.6 billion worth of real estate and not have your hurdles. But everything's worked out pretty well for us.
Yeah. Yeah. I think you said you analyzed the data, and you said that it was like less than 1.5% default rates, right? It's still pretty low.
Yeah, very low. Um, yeah, 4,500 loans, over 4,500 loans. It's a pretty remarkable thing. And
So in that context, so when you have a default, um, talk to us about that, because that, people sounds like, oh, that sounds like it's terrible, but actually you actually make more money on a default, right?
you do, you get your late fees, you get some default fees, which can jump up into the 20%, right? Um, and in some cases, you take the property back and you make even more, right? But if you do a good job, it typically sells at auction. So you go through this process where there's kind of these real defaults, and there's these um, soft defaults, meaning a borrower thought that his payment was on auto pay, and didn't realize it didn't go through, right? But it triggers a late pay. So you pay those fees, and you pay some late default fees, right? And it gets baked in there. Um, but you work those out. But essentially, you can have a borrower who, it's just there's no restructuring, there's no kind of going back, and you have to do, as a fiduciary, do what's right for your investors, right? And we're in the business of making loans, not owning assets, and so from that point, you kind of assess what's the next path. Is it um, to issue a notice of default and push forward to foreclosure, or is there a path where you can get creative and maybe you extend a couple of different like levers, maybe more money, maybe we sell the note to someone else who's looking for that type of paper, right? But more often than not, we would work out the loans with the borrower, and and it just kind of get it performing.
Yeah, I think that's a great way to, for context, that this category is called private credit. Some call it private money, private debt, and hard money sort of is inside of this broader private bit. But a hard money oftentimes is a loan to own. Not always, but the loan to own characters are kind of in the hard money camp, and their, part of their strategy is to hope that the borrower defaults so they could take the property back
Right.
and make money that way. And
Yeah,
that's
I think so. Hard money traditionally is asset based, right? I mean, what's that mean? That means I only look at the asset. I don't care about the guarantor or the borrower. So when you do that, um, you can be fine. You can lend at 60 cents on the dollar, 50 cents on the dollar, and you write your high yield, and he has to pay me every month. But again, if you don't do any background or underwriting on the borrower, that can lead to problems really quickly. But if you take a deep enough position in the loan, you feel comfortable because the market's good. I'm at 60 on the dollar, 50 on the dollar, and it moves its way out. But I have the saying, and shout out to my buddy at Artez Capital, Scott Taylor, who's been incredible for us. Um, you know, people pay back, properties don't. And it's such a true saying. And so when you focus on credit worthiness and the borrower, you should most of the time stay out of trouble, right? And I think that's sometimes hard for people who are in a position where they have to put money out quickly, right? Some of the trouble I've seen with early managers is they've always put themselves in a position where they've taken on too much money and they've got to put it out. And what happens when you do that? You kind of skim over the irrelevant stuff, right, and your principles, so that you can deploy money. Um, I have always taken the approach that go slow to go fast, as we say. I think Duke says that. So it's very true saying. You got to be very thoughtful, and then when you start doing business with the best borrowers, naturally what happens is all their competitors want to know why they're doing business with you, what makes you so special, and that leads to you know referrals, um, inquiries from the best borrowers. And I think I told you this. I never once spent a dollar at Quanta for marketing, not $1. And that was all word of mouth. And we were just really great operators and service providers, and it paid true. So
Yeah, I want to double click a little bit more into the some of the details. I want to talk about liquidity, talk about the
yeah,
collateral, but just started to put a bow on Quanta. You were there 6, 7 years. You were one of two founding partners. You were the junior of the two, and you sort of had a vision to want to do something on your own and with your own philosophy, and also have your equity based approach versus being reliant on a wholesale line from a hedge fund. Although they were a great partner,
yeah.
it's sort of a tail wagging the dog sometimes. You go through COVID and the hedge fund, their buy box changes, and it can be a lot of brain damage. Give maybe a little context about, and then we can kind of segue
Yeah,
back.
let me start with. I'll just go back to the fundamentals with One Sharp. One Sharp's a hedge fund. They purchase short-term paper, such as what we invest in, right?
Yeah,
But Rob Blunker and team's philosophy is liquidity above all, and the minute you start to go upstream in bigger value assets, liquidity kind of goes out the door, right? But if you can stay in a liquid market, and what that means for the crowd is, if I'm investing in a market of, call it sub $1.5 million, so I'll call it LA, right? Where maybe the value of a home is worth a million, million two, and our loan amounts at 700, $600,000. In the event something happens where we need to pivot, we are in a very liquid position where I could reach out to someone and sell it, or if the borrower defaults and I have to take the property back, the rehab is very minimal, where it's like call it anywhere from 50 to 80 grand. I can step in there as an operator. I've done this before. We have other partners on the ground, boots on the ground. They finish the project and we sell it. Now, when we go to sell it, we're not bound to Wall Street to sell that property, right? Because it's so liquid. There are, billions of people looking for single family homes to move into. And so putting on the market, get our money back, principal, interest, maybe some other fees, legal default fees, and we move on. And it's a very easy process versus us lending against a $20 million, call it multi-unit, very valuable, no doubt. But in terms of liquidity, there's very select amount of people that can purchase that type of asset, right? Whether it's a hedge fund or it's a private equity, high net worth, it's just not very liquid. So it makes it challenging to uh, maneuver in those positions. But when you have billions of dollars secured by thousands and thousands of properties, the diversification is very different than us having billions of dollars against 50 apartment buildings, right? And so liquidity to me is all, that's one of our strongest philosophies, right?
Yeah, and the technical term, I'm kind of doing my self study of CFA, and liquidity is sort of a measure of how close to cash is it. So
Right.
you're basically saying that you're serving these workforce housing markets or level luxury in top tier one cities, top MSAs, cities like LA, San Diego, Austin, Nashville, etc., across the US. And if something happens, which it's not very often because you're doing a good job underwriting the asset and underwriting the borrower, but when it does happen, you're able to you know get liquid or get rid of the asset because of
Yeah.
the collateral. That all makes a lot of sense. And I think another way to say it is you're not lending money to these high end developers that are buying a Hollywood Hills tear
No.
down for 5 million and putting 3 million into it, total cost basis of 8, and trying to flip it for 12, 15 million. That's not your business.
It's not. To be fair, I've been approached with a lot of that type of deal flow, and it typically just never works out. There's other competitors, and they can have that business. But there's I always tell people there's always a loan for everyone, and what my loan I might offer that person in Hollywood Hills probably doesn't make sense. But
Yeah.
hey, oh, you buy the land free and clear for $10 million, and you need another $10 million to build the property because you think it's going to be worth $40 million. Well, how about I give you $4 million against it's free and clear, right? And that makes sense to me. It's highly improbable that borrower is going to take that. Um, but there's always a loan where I would really be willing to extend. But that's
Yeah.
that's the level of liquidity that I
Yeah,
want,
that's a
right?
great example. Yeah,
Yeah,
and I think the thing you and I are very similar this way, where we're very much try to help the customer.
right,
And if we can't help them, let's go refer them to somebody that can. Because
right.
oftentimes, the referral source upstream might be look at a deal. Yeah, it's a little bit too small for us, or not quite in our box, and send it back over. So I know, I when I was at Hunt Club, I would send stuff to competitors all the time that weren't a good
Oh,
fit for us. They'd send it back. I mean, I've always done that. I feel like
yeah,
you're the same way.
yeah. And I think that's what's I think made me one of the things that made me relevant in this business is that when you deal with the best in the business, they really start to appreciate your opinion and your insight. And when they know that you're really trying to their interest is above in front of yours,
Yep.
I mean, it just pays so much dividends versus you trying to BS them into a loan or
Yeah.
just kind of chaining them along. Time is money, and for everybody. And
Yeah. You're
our
helping them
whole
trying to find the best solution, and if that solution is you, then great, and if
right.
not, they're gonna come back the next time because
Because
they'll know
reality
that
is
you were.
we're going to
Yeah.
have so much business that we'll do, and if I don't do, you know, that all his business, I'm not going to lose sleep over it, right? So
Yeah, one of my mentors, Dale Okuno, who is our angel investor at City Source, taught me the concept of a bad sale, which is really intuitive when you, like, think about it, but, when you make a bad sale, it's something where you end up wishing you hadn't made the sale because you're not able to serve the customer and you were short-sighted to get the dollar, and then the customer's unhappy, you wish you hadn't done it, and it's just a lose-lose.
Yeah, one of my mentor at Genesis, Andrew Smith, one of the best things he's ever said to me, and I've carried this over, is sometimes the best deal you'll ever do is the one you didn't do. And
Yeah.
it's so true, right? And there's always this again, the mindset of people that just need to do these deals. And but saying no, honestly, is probably the best trait I have, where it's not everything's going to work out, and it's not meant for me. It doesn't mean that someone else won't do it for them, but
Yeah.
yeah.
Um, anything else to tie up around Quanta?
Um,
Or let me ask you this: what were you really grateful of or proud of at your time there? Have you built an incredible team? Pretty incredible learning. You made a lot of money, made a lot of people happy.
yeah, we did really well, and I think it was my first um, real run as at the helm of a business, making big decisions and growing a company. I learned a lot of things that about the credit markets and myself. We had some incredible people there. I learned a lot of things what I won't do going forward,
Mhm.
and I think that's just life's beautiful way of teaching us, right? We learn from our past and we apply that going forward. But yeah, I think more than anything, the relationships there, there's some special people. One of the guys I used to work with over there at Genesis carried on over at Quanta, Jason, and he's just an incredible guy, and a really good friend of mine. And we got to do business together, right? That's the kind of what you and I talk about, like doing this venture is like we get to work with who we love to work with, and we're learning, and hopefully we make everybody some money along the way.
Yeah. Yeah, we had a really special kind of team meeting this last Wednesday, two days ago, uh, and we had got cleared the capital. We're all good to go, and first money's coming in, and I just acknowledged you for having the vision for doing this, and said some nice things that were all true, and I also acknowledged you for bringing opportunity for me to ride along, and you brought Elias Bedeen, our third partner and CFO, who you guys went to high school together and were housemates. And I think this all sums up to this idea that I think, I don't know, I'm not really, you think about things like winning and losing, and I don't really tend to think in like win lose terms. I'm more of a kind of, I'm not really a zero sum game guy. It's more of a win win. But
Yeah,
in the context of winning, it's like, oh wow, like I get to work on something that I'm interested in. Like I'm loving learning about all this stuff, and bringing what I'm good at to the party. And one of the things is I'm really good at learning new stuff. And the other thing is being able to do it with people like you that I just, become a very close personal friend.
yeah,
And then sort of this idea of being able to work on what you want, what you're interested in, with the people you want to do it, and be
yeah,
able to make a really nice living doing it. I mean, it's just I can't think of anything else that is more meaningful. And then and one of the things that we kind of huddled around and we got aligned around was this idea of the business being a mechanism for self-actualization. How can we be better humans in the process of the business we're running? How can I be a better husband to my wife? How can you be a better husband to your wife? And same for Elias. Be better, parents, friends, brothers, colleagues, vendors to our customers, like all of it, and it all matters. And it's like, I think it's about having a first principle of, of integrity. And we got into a whole discussion about integrity, being more than a moral thing, have it being like a performance. I think we're kind of talking a bit about values and philosophy, but I don't know. I really do believe that, we're just so fortunate to be able to have this conversation in the context of everything we're doing. And I'm just really grateful and so excited. And, I know there's going to be a lot of challenges, there already have been. How we learn and, use the challenges to get better and, have increase. I love Scott Taylor at Artez, who's been mentoring us, and he says, "You guys, as long as you can, you know, continue to treat each other with trust and respect and not take things personally. And we were able to have some really kind of intimate discussions in a way about even how our preferences were and how we like to be communicated to. And just felt really good to see how we as a team are coming together. You and I have been working really well in sync, and how Elias in 3 weeks is already, adding to that harmony. And I feel like we're setting up a really good foundation. I feel like I'm getting a little preachy talking about this, but I'm generally really like passionate and excited and believe
Yeah,
in this stuff.
no. I think just to add on that, I think what's one of the coolest things that we're doing here is that we're building this community of whether it's vendors, partners, like Artez, like they're somewhat in our space, but not really. They do more commercial versus residential. But Scott has been such a great ambassador for us, just an educator. And we're figuring out ways, how do we work together on future projects? Is it we share information? Do we co-fund into deals? And having that kind of like, to Duke's point, bonfire, right, where
Yeah.
we build this community, is something I didn't have at Quanta, and be
Mhm.
quite frank, we didn't have at Genesis. So to incorporate that on this next iteration of this this company
Mhm.
that we're doing, it gives me all the confidence in the world that we're gonna do really well. And just be patient, and as long as we stick to our values and our philosophies, and build this great community of partners, we're going to do really well. And I just want to throw a shout out there to even Morton Capital. I wouldn't even have met Scott if it weren't for Jeff Sardian, um, and Stacy McKinnon. And it's they're always just so thoughtful in making introductions. And Scott has been, more than an introduction. He's become, a great friend, and I can't thank them enough. And even though Dan helping us out, getting on board with some of these qualified accounts with IRAs and 401ks, but it, it's incredible, right? And so we have this community we're building, and it goes both ways, right? I introduce people to Scott, he does the same, and it's just a great environment where
Mhm.
people want to see other people win, and they want to make introductions, and
Yeah.
that, I think, is something cooler, right? And I'm super appreciative of everybody.
Yeah. Morton Capital out of Calabasas has been incredible. And you introduced me to them early in our friendship, and they connected me to their trust attorney, um, Brian Stanling, who did our trust. And the guy is so good. And it's like that thing you say, if Morton introduces you to somebody, they're vetted.
Yeah,
You know that you can count on them. And and I think what we're trying to do is very much an extension of that. And I think that's sort of like, that's been my trade craft. I've been really good at kind of being a connector and being really thoughtful. I think, little research around that. Adam Grant out of Wharton, very, very prolific researcher and author, wrote a book called Give and Take. It's a short little book. If you haven't read it, it's worth a read. The insights are really about what we're talking about here. He talks about in the book, there's three classes of people. There's givers, there's matchers, and there's takers. And the matchers are interesting because they sort of feel like givers, but they're not. They're quid pro quo. So you actually have to watch out for the matchers. But the takers are pretty obvious who they are. You want to
yeah,
stay away from the takers. But what was so insightful about the book, and I think this is what who we are naturally, and I think what's like what Morton is, they seem to be too, is there's two classes of givers. There's givers that give to other givers, and then there's givers that give to anyone. And it's interesting because the givers that give to other givers, it's not like they're matchers. They're not giving for a quid pro quo. They just naturally are that way. They just have ability to somehow recognize, um, you know, who the other givers of givers are versus the matchers and
right,
the takers. And
right,
the insight was amazing because I'm kind of burying the punchline, but the insight is this: the givers that give to other givers outperform all other classes. And the givers that give to anybody underperform all classes. And it was really profound insight when I read the book, and I was like, oh wow, like maybe that's why I've been pretty lucky. because I'm pretty thoughtful about who I take care of, but I don't do it in a quid pro quo kind of way. Like if they
Right.
don't give back, I'm not gonna worry about it. I'm just doing it out of the generous out of my heart. I think that's also coming from a place of abundance versus scarcity. Knowing that the world, universe is gonna take care of us, and that if you just do right by people and just try to help, it's all gonna come back to you, and you're not really keeping score. Maybe that's what it is. The givers that give to other givers aren't keeping score.
Right. That's a great way of saying it. I totally believe it. I believe the universe has a way of circling back at some point, and maybe it's tomorrow, maybe it's, I don't know, 20 years down the road. But I think if you put in that type of energy with no expectation to give back or to get something in return, the universe has a great way of rewarding you for that.
Yeah. I think we could talk a lot more about values. We have our values on our site. Some of them I'm pretty excited about. Don't confuse the map from the terrain. Even yesterday, driving to lunch, I got lost and I was like looking at the map, and if I had just been looking out the window, I would have figured out where I needed to go. So I think you're really good about that, where you look at the data, but you're actually looking at the borrower and you get an intuition about, are these people going to pay me back?
Right.
That's you analyzing the data, the file, the map, but also looking into terrain. And
Yeah.
we have a bunch of other values that we're working through. But those are, I'm excited to get those really working uh, together for us and our community and our team. Some other things I wanted to talk about, kind of flipping gears a little bit, and we could wrap up in the interest of time. It's just like the general macro landscape. It seems like there's a lot of like it's an interesting time right now. Interest rates highest that they've been for mortgages in over 20 years. Um, in the squarely in the high sevens. Listings are like at an all time, like not all time low, but like really low. There's a lot more. It's an interesting space, time and space. The market's sort of frozen. My dad Pete is a top residential real estate agent out of Ventura County, and he's talking about just how little inventory there is in the market.
Yeah.
And one of the things that we talk about and why we're excited about our asset class is just how solid the collateral is. And for the audience, couple things just for context is, if you this is from the Fed's website. Question is, what percent of homes do you think have zero debt and are paid free and clear in the United States on average? If you think about it, the answers I hear are range when I ask a question from 10%, north. I don't usually hear more than 30. The answer is 42. So 42% of all homes in the US have zero debt, which is,
Yeah.
when I first heard this stat, was mind
Mind
blowing.
blowing. Yeah.
Yeah. Like,
Incredible.
and it's the boomers. They retired. And the reason this happened is after World War II, the United States government wanted to create a long-term 30-year fixed mortgage to make it easy for people to get into homes and have an embedded retirement savings, and then also one that would play defense against inflation. And here we are, these boomers bought these houses in the 70s for 30 grand that are now worth, well over a million, and they've been paid off for a minute now. And the thing that's wild is the boomers are doing great. They're living longer. So, they're not going anywhere. The other 58% of homes have an, if I were to ask a question, what's the balance of debt? What's the average LTV on the other 58%? I ask that question and people give me a pretty wide range of answers. And the answer is 50.
Yeah.
So 50% of, you know, the other 58% of homes that do have debt, the average loan to value is 50%. So if it's $1 million house, they have a loan balance of $500K on average. $800,000 house, $400,000 loan. That's a lot of quote unquote nested equity.
Yeah.
And all of that equity, by and large, refinanced during COVID at a 30-year fixed at a 2.5%, 3%, 3.5%. And and they're not going anywhere. So what we're calling a mortgage rate lockdown. And there's just that's another dimension. So you have all the houses paid off, everybody else that has debt is locked in, and they're not going to trade their house and sell it for a 7%, 7.5% loan unless they have to sell. Forced sellers, death, divorce, moving, or maybe a job layoff, which the job market's really still strong. And then you have NIMBYs that don't want any new housing built. Not in my backyard. They don't want any new stuff built. The new home builders can't build in a high rate environment. It messes up their economics, so they're slowing their roll. And then you have millennials that are making money, having families, and they want to get into the market. So it's a really, really unprecedented, truly unprecedented time in the residential real estate market in the United States. And our point of view for all these reasons is why it's such an interesting and rock solid asset class as collateral. And these housing crash bros that are on TikTok and YouTube and say the sky is falling, they don't really have the data. I think they're wrong. I would love to stand corrected. And if anybody has data that we're not looking at, please do let us know by all means. But I think these are all very, very interesting dynamics on this market. So that's me kind of going on a little bit of a rant, but any sort of thoughts?
Yeah, I think you bring up some great points. I, I'm somewhat of a contrarian in how I see the world often. A lot of times I'm very social, so I go out and mingle in parties and, all different types of classes. You go into the city, go here and talk with people and really get a sense of what they're going through with their daily lives. And um, I think that, this environment, high interest rate environment is, we're really, the economy is really beholden of the consumer. And I feel like the consumer is in a position right now where they're still spending, but they're obviously spending and borrowing at higher clip. My question is, how long is that sustainable, right? I don't know that there's a soft landing involved, but I also don't believe it's the '08, '07 again.
Yeah.
I think credit has become so much tighter in terms of how we underwrite, and all those people who got mortgages from like 2012 on, credit standards are very tough, right? Really strong. So
Yeah, I told you in that same breath, it was harder for me to get a second mortgage HELOC at Bank of America on our
yeah,
primary residence when we were living in Camarillo
right,
2 years ago than it was to get the first mortgage. And the first
right,
mortgage underwriting was really tight. For the audience, I was a mortgage broker for 5 years from '04 to '08. And it was, it was like to your point, ninja
yeah,
loans. I watched The Big Short again last
yeah,
week.
yeah. It's great, great. Read the book. The book's even better, in my
Yeah.
opinion.
And I agree. The underwriting got really tight in the post GFC. So in the 20 years ago going into GFC, it was a credit boom. And I think this last kind of run up we've had. Oh, I think the other thing is too, we did take our medicine. Like we had in the United States, international people appreciate this more than we do, because they have the context and we don't. We're the only market that really imploded. Everybody else just kept going.
yeah,
And they're all having to take their medicine now overseas because they don't have fixed rate mortgages. Canada, Australia, Sweden, they're on these short-term variable rates. They never took the medicine. And so those markets are having much more depreciation and kind of a reset than we are. I guess on this recession bit, we do lose jobs. I think there will be some, impact to prices, but I don't think at the margin it's going to be that much because most people that, lose their jobs, I don't know a lot. Not, I guess the question would be, Justin, like as an underwriter, how do you think about or a risk manager? Do what are the signals that you see in the context of like unemployment or any of this stuff, macro trends that would impact you as
Well, I
far as
think
your
if
risk?
we are one of our philosophies is we lend in tier one markets, right? What is a tier one market? Job growth, population growth, um, And home appreciation, what does that look like? And if we start to see unemployment really start to tick up, that obviously affects some of those philosophies and how we lend and where we lend. And so I think I am very focused on watching job growth and unemployment. I mean, unemployment is a huge indicator, right? And so if that starts to tick up, the double. I mean, we have a while to go before it even gets. Well, I don't know where we're at today, but I think it's less than 4%. But when that starts to tick up, then I think that's when you start to be a little bit more cautious, right? And we have to forward look into that market, right? If we're at 4 today, where do we think we're going to be in 6 months? Where do we think we're going to be in 12 months, right? And so because we lend into that forward projection, so I really focus on that. I am a little bit of a believer that I think things are going to get a little bit more challenging before things get better. But doesn't mean I'm right about everything. But so having that in the back of my mind, I think has made me just a better underwriter and a better steward of money. So I'm still bullish about real estate. I think I'm really bullish about specifically residential. I think it's probably going to be the strongest asset class in real estate for the next decade. Um, and so I think that's why what we love. I think we're going to do quite well in private credit for the foreseeable future.
Yeah, a lot
And
of
even
in
with
that same.
sorry, I
Go
was
ahead.
even with the the regional banks pulling out. I mean, people are going to really lean on private credit more than ever, right? So, and we just have to be really thoughtful and mindful of market dynamics.
Yeah,
Hey,
it's in a little insider. We're going through a process right now to get approved through Schwab and Fidelity and Millennium to be able to accept qualified IRA funds, and they're all backlogged because there's so many new private credit funds coming into the market. So private credit is having a moment,
yeah,
and we're also hearing that it's a great time to be doing what we're doing because we're starting with a clean book. We don't have a legacy paper, and
no
as we're
legacy.
kind of scaling into assets under management, we can be really thoughtful about what loans we make, and we can, I think, if market timing in this market is a thing, we're probably uniquely positioned to be able to best take advantage of that for all the
Yeah,
reasons we talked about, and your
yeah,
experience and just some good old fashioned luck of
yeah,
timing. Yeah. There's so much more we could talk about. I'm really excited about being able to go to market, and we're going to be pushing out a bunch of content. So for everybody following along, that's interested in uh, following, for my podcast audience members that are interested in what I'm doing more personally at work, you can go to rwagroup.io and follow along, sign up if you'd like to learn more. And for everybody else listening, thank you so much for your time. Justin, I'm so excited to be doing this and having this conversation and sharing the good news about what we're doing, and also celebrate your journey and our partnership. And thank you again. And I wanted to ask kind of two kind of uh, closing questions. And the first one is something that I do all the time with the show. People love it. Is you could, what a music fan I am. If you could have any band or a musician or audience play any venue in the world, who would it be and where? It could be, past, present, future. It could be in your backyard or at the Hollywood Bowl. Rapper, singer, songwriter, artist. What comes to
yeah.
mind?
I'm gonna follow in SJ's footsteps with Tom Petty. Hollywood Bowl would be that was my thing, but that's kind of come and gone. And good life lesson, take the opportunity while it's present, right? So
Yeah,
Tom Petty, Hollywood Bowl would be that.
yeah,
That
awesome. I got to see Tom Petty at Coachella. It was amazing,
yeah,
incredible. Yeah. If people want to get a hold of you, I know you're pretty private. You're not as online all the time like your partner Curdy D. But people wanted to follow. LinkedIn's probably a good place to
yeah,
get in touch.
yeah. That's a great place.
Yeah, and easy to find. And you could always get a hold of me as well. And Justin, thank you so much for this opportunity, for taking time today. And I'm so excited to be riding shotgun and Let's keep going.
Yeah, thank you. This has been great, and I look forward to the future.
And thank you again to my friend Justin Mitchell for being our guest. I could not be more excited about this episode and what we're bringing to the world with RWA Group. Feel free to check out our site at rwagroup.io to learn more. And I'm at Curdy D on Twitter and Instagram, also Kurt Derdix on LinkedIn. The content moved you, please do give us a rating and review. And until next time, Curdy D loves you.